Today I really want to get into a key topic that I think is absolutely crucial for anyone looking to boost their income through investing. And this is why closed-end funds, or CEFs, are likely to blow up in 2024, this year. So why should you care then about closed-end funds and CEFs? Now look, if you're a new income investor, understanding this particular type of unique investment vehicle, it's going to make a really big difference in your ability to generate income in your portfolio, because CEFs are a little bit different, just a little bit different from mutual funds and the normal ETFs, or exchange traded funds, that you might already know about. Closed-end funds offer some really interesting opportunities, but they also come with their own set of risks as well. And these risks, well, my friends, they could become very real in the next year or so. And that's what I want to talk about here. So look, in this video, I'm going to break down, what exactly CEFs are, how they work, and then why they could be heading for some really big problems and really big troubles now in 2024. I'm going to be talking about premiums versus discounts. I'm going to be talking about the role and the importance of leverage. I'm going to be talking about the potential for economic triggers that could lead to significant declines in CEF prices. By the end of the video, I want you to have a really good understanding then of why it's important to keep an eye on these investments, and keep an eye on the investments and how to then navigate and get over and avoid the potential pitfalls of investing in CEFs. Alright, now let's start then with the basics. What exactly are these closed-end funds? What exactly are CEFs? Now look, if you're familiar with mutual funds and ETFs, you may simply think of CEFs as their sort of less talked about little cousin. But CEFs actually do have some really important distinct characteristics that do make them really important to understand a bit more deeply, especially if you are a new income investor. Now first of all, unlike mutual funds and ETFs, which can issue new shares as they need, CEFs have a fixed number of shares. Now what this means is that once those initial shares are sold during the fund's IPO, no new shares are then created. So these shares do trade on the stock exchange just like individual stocks, which is really helpful for individual investors. But the limited supply can create some really interesting dynamics that we need to be aware of in their pricing, and we're going to get into that in just a little bit. But another really important feature of CEFs is their use of leverage. Now yes, leverage can boost and juice those returns, but leverage is the borrowing of money to invest so that the company has more than the actual fund's capital. Now while this can amplify gains in good times, it's also going to magnify those losses when things go south. So this is, my friends, very much a double-edged sword, and it's going to require some really important and careful consideration on your part. So first of all, let's talk about pricing. Now the market price of a CEF is not always going to be the same as the net asset value, unlike with ETFs. So the value of a CEF's underlying assets minus its liabilities is the net asset value. Now CEFs will often trade at a premium or a discount to the NAV. Now, a premium will occur when the market price is higher than the NAV. On the other hand, a discount is simply going to be occurring when there's a lower price. Understanding, though, these concepts is really important and really crucial for us as investors, because premiums and discounts can substantially affect our investment returns. So look, there you have it. That's a really quick rundown of what a CEF is and how they operate. But next, I want to really get into what these premiums and discounts are and why they are important for you and for me, and why they should be a key part of our investment strategy. So let's talk about it. One of the most compelling and risky aspects of closed-end funds is the leverage that they take on. Simply put, the leverage is going to be the borrowing of money so that the company can invest more than the fund's actual capital. Now this does massively increase their returns, but it also comes with a substantial and significant potential downside for the fund. Now I want you to imagine if you had $100 to invest, but you used leverage, you could effectively invest, say, $150 or more. Now if those investments are going to perform really, really well, then your investment returns are going to be magnified because you're earning returns on a larger amount of money because of the leverage that you're using. But now the flip side is also important. If the investments perform poorly, your losses will also be magnified. And this increased volatility makes leverage a double-edged sword. So let's have a look at a really good example. Suppose the CEF uses 50% leverage. The underlying assets increase by 10% and the return on the leveraged portion could then amplify your total return by 15%. Now, my friends, that does sound great, doesn't it? Here's the kicker though. What happens if the assets decline in value by 10%? Well, that leverage is going to turn your 10% loss on the assets into a 15% loss for you as the fund, and that's going to hit your portfolio much, much, much harder. Now, this is really important, and it becomes really concerning during volatile or declining markets. So when a market condition worsens, these leveraged funds can experience very sharp declines in the value, much, much, much faster than their non-leveraged counterparts. Now, this is why understanding the role of leverage is really crucial for any investor that is looking at adding CEFs into their portfolio. Now, another really important risk is that during tough economic times, funds are going to potentially face a liquidity crunch. Now, this is when it's difficult to meet their borrowing obligations. Now, this could then force them to sell assets at unfavorable prices, and that can further exacerbate their losses. So look, while leverage can and does offer higher returns potentially during good times, it's also really important to be aware of those risks that are involved. Now, the next thing I want to look at, though, is what could potentially trigger and cause the CEFs to blow up in 2024, and then how leverage is going to play a really critical role in this scenario. So let's get into then some of the nitty-gritty of why I am treating CEFs as potentially quite risky here today in 2024. Now, there's several really important potential economic factors that I think could spell trouble for these very important investment vehicles for income-focused investors. Now, first up is the possibility of rising interest rates. When interest rates go up, the cost of borrowing increases. Now, this directly impacts the companies, the leveraged CEFs. So it's really important to know that the higher borrowing costs can absolutely squeeze profit margins there, and this can lead to a substantial decline in the market price of the CEF as investors reassess the risk-reward profile of this investment. And that's important to keep in mind, because we also have to think about the broader economic environment. An economic downturn can lead to a rapid decline in the asset prices across the board. Now, a leveraged CEF is going to be hit by this catastrophically, potentially, because the value of the underlying assets falls. And of course, as we know from leverage, this impact is going to be magnified by the leverage, and that can then lead to substantial and significant losses, which can really hurt an investor. It's this selling thing that can trigger a wave of panic selling and further drive down the prices, and this is going to lead to the potential for a liquidity crunch, because in times of market stress, liquidity can dry up very, 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 very quickly. And it's important because CEFs relying on leverage can face this, and it can be particularly dangerous and hazardous to them, because they may find it difficult to meet their margin calls or difficult to refinance their debt at reasonable rates. Now, in extremely extreme cases, they may be forced to sell assets in a fire sale at fire sale prices just to stay afloat to meet their obligations, and this exacerbates losses and locks them into a very vicious and dangerous cycle. So combined, a perfect storm could very rapidly lead to a blow up in 2024 for CEFs. Rising interest rates, borrowing costs going up, and an economic downturn could magnify losses through leverage, leading to a liquidity crunch, which could make it very difficult for the fund managers to manage these pressures. So look, my friends, understanding these risks is crucial for you as an income investor if you want to consider adding CEFs to your portfolio. So the next thing, Lincoln, you could say, is this just theoretical? So I want to take you through some historical precedent to understand how these scenarios have played out in the past and really understand what we can learn from what's happened in the past and think then through some of those key risks tomorrow. So to better understand some of these risks, I always think it's helpful to look at some of the historical precedents to understand similar conditions and to understand how it has impacted and how those declines happened. Now, history doesn't always repeat, but it will often rhyme, and these past events can give us some very valuable and useful lessons for us as investors. Now, probably most notably is the 2008 Great Financial Crisis, and during this period, many leveraged CEFs experienced severe declines. Now, as the market for mortgage-backed securities and other risky assets collapsed, then the value of the underlying holdings in the funds would often plummet. The leverage then amplified these losses, and that resulted in catastrophic declines for investors. Many funds actually lost more than 50% of their value in just a matter of months. Now, I want you to imagine what would happen to you emotionally if your portfolio lost that amount. And these leveraged funds then resulted in a deteriorating position for many investors. We could also look all the way back to the dot-com bubble in the early 2000s. And while this primarily affected tech stocks, it did have a ripple-on effect to other leveraged CEFs that were invested in high-flying but otherwise overvalued tech companies. When the bubble burst, the sharp decline in asset values was magnified again by the leveraged in these CEFs, and that led to substantial losses for CEF investors. Now, more recently, COVID-19. There was a market crash there in March 2020, and this provided another very powerful example of problems that can crop up suddenly. The sudden and severe market downturn caused by the pandemic led to a liquidity crunch, and these leveraged CEFs faced margin calls, and many were forced to sell assets at depressed prices, again, simply to cover their borrowing costs as they are required to do. And this further drove down prices and created a cycle of losses. So look, as an example, there were countless individuals that found themselves absolutely entangled in the downfall of the very, very popular Nuveen Energy MLP Total Return CEF. It's a now defunct fund which held a lot of promise and was very much loved by many investors. It had a really good discounted trading prices, exposure to massive MLPs, and it seemed like a really good golden opportunity. But the fund's 30% leverage ratio, in good times, it bolstered the dividend yield. It turned out to be a very dangerous double-edged sword. So when the COVID outbreak sent shockwaves throughout many sectors, and particularly the energy sector, the fund's vulnerability was absolutely exposed. The sharp decline in prices led to the fund's ultimate demise and forced a liquidation because of the insurmountable debt and margin debt and the pressure on the fund. Now, these historical events teach us that while leverage can, yes, enhance returns during good times, it can also lead to very rapid and substantial losses for investors. And this is particularly true during powerful market downturns. And so it's really important for us as investors to be aware of these risks and to consider them when we evaluate CEFs as part of our investment portfolios as we move forward. So what then should we be looking for in a potential blow up in CEFs, and how could this impact us as individual investors, and what steps could we take to mitigate these risks? And these are all really important questions that we all have to think through carefully. So what would then a potential blow up in closed-end funds look like, and what would it mean for you then as an investor? Now, the impact can be quite substantial and significant, particularly if you have a heavy concentration of CEFs and you rely on these funds for income. So look, first and foremost, there is a risk of capital loss. Now, if the CEF prices plummet due to rising interest rates, for example, or other economic downturns, or there's a liquidity crunch, the value of your investments can drop sharply and quickly. Now, for investors holding CEFs in their portfolios, this can lead to substantial financial losses. And as well as that, we also need to consider the effect that it's going to have on your income stream, because many investors are attracted to CEFs simply because of the very powerful and very high dividend yields or distribution yields compared to other investment options. However, if the underlying assets held by the CEF decline in value and the leverage magnifies those losses, the fund could very well be forced to cut the distributions to investors, and that could mean that your invested income and your expected income could be substantially reduced at a time when you probably are going to be wanting to see that income the most. The other thing to remember is that during a market downturn, liquidity can become an issue for CEFs. And so if you're actually looking to sell your shares, if you want to cut your losses or reallocate the investments within your portfolio, you may find it very challenging to do so without accepting a much lower price. Now, this lack of liquidity then can trap you in a downward spiral in your investment, and that can also exacerbate the financial stresses that you feel as an investor. The big thing then is, what can we do to manage these risks? And once again, diversification is key. Don't put all your eggs in one basket. And always assess the amount of leverage they have. Invest over different asset classes and invest over different sectors, and look at different investment vehicles, not just CEFs. Check the investment and leverage levels of the CEFs that you invest in, and make sure that you're not just in leveraged CEFs, that you have some unleveraged CEFs as well. Stay informed and be proactive. Always review your investment portfolio on a regular basis and be prepared to make adjustments based on the changing market conditions. And of course, finally, always get individual professional financial advice and get a professional to help you to tailor an investment strategy that's going to be aligned with your risk and your tolerance and your financial goals. It's really important that you understand these risks with CEFs, and that you then take the steps necessary to mitigate the risks so that you can avoid those potential pitfalls and protect your family's investment income. So, the next thing I want to do is just wrap all of this up and give you some of my final thoughts then on closed-end funds and CEFs and why I like them despite all of this. So I want to now quickly recap some of those key points that I've talked about here around closed-end funds, CEFs, and why I think they could face a significant challenge here in 2024 moving forward. And I think understanding these risks is going to be absolutely crucial, especially for new and emerging income investors who want to build a stable portfolio. Now, just to remember, we first of all talked about what a CEF is and how they're different to mutual funds and ETFs. So the fixed number of shares is important because they can then trade at a premium or a discount, and they can also use leverage, which makes them somewhat unique, but also adds several layers of complexity and some hidden risks. We then also looked at the concepts of premiums and discounts a little bit more, and we explained how those market prices can differ from the underlying net asset value, or the NAV, and then what that means for you as an investor and for your very, very important investments. Now, leverage, yes, it can be good when times are good, and nobody questions it when times are good, and it gives you the potential for much higher returns, but it also can increase volatility and can lead to substantial losses. And we've seen historical precedents here where leveraged CEFs have suffered dramatic declines because of market conditions, such as the 2008 financial crisis, the dot-com bubble bursting, and of course, much more recently, the COVID-19 market crash from about March 2020. Now, as we look forward to 2024 and the end of 2024 moving into 2025, there's a lot of economic factors that I think could trigger a big blow up CEFs if we're not being careful. Rising interest rates, economic downturns, and liquidity crunches are all substantial threats that I think we need to be aware of, and we need to think about and talk about a bit more, because it can lead to catastrophic declines in CEF prices. And it's really important because I think these factors could actually really, heighten the risk that many investors have if they're overweight in CEFs as leveraged investment vehicles in their portfolio. Now, for individual investors, this blow up could mean capital losses as well as a substantially reduced income stream. And this is particularly a problem for people who absolutely rely on these closed-end funds for regular income. So diversification, staying informed, and also seeking professional, individualized and tailored advice from a professional are important strategies to help you to mitigate these risks today. So look, my friends, while I do believe that closed-end funds can be incredibly attractive because of those yields, it's really important that we understand those inherent risks and that we're very well prepared then for potential market changes in 2024. So look, I want you to stay informed, I want you to stay vigilant, and I want you to always consider those broader economic landscapes around us as we make our investment decisions in CEFs.